Thank you for joining us, Mark.
Thank you. Good to be here.
This is round 2 for us. Last year at our Super Efficient conference, we launched the first round of some switching research, which ended up being called The Wrong End of the Switch. My favourite title amongst those listed was When the Switch Hits the Fan. That was vetoed, unfortunately. But that research had some really scary statistics in it that suggested that we really haven't learnt the lessons of the GFC as super members. And this second round of research that we're going to go through today goes into that in a little bit more detail. So we're going to go through some context, a very quick backdrop for the research itself. We're going to go through the key findings of this round, and then we're going to give you a bit of a snapshot of what we think the way forward is in terms of addressing the issues that the switching research has raised. As I said, wrong end of the switch. I did prefer when the switch hits the fan. But as I said, we really realised that we haven't learnt the lessons of the GFC. We saw switch volumes triple, and at the worst times, some 70% of members' switch behaviours saw them worse off, and to the extent of almost half of their switched balance being wiped in the worst case scenarios. So we really then dug further into the research, and we're going to take you through that today. But do you want to give some quick observations, Mark, on that first round?
So look, I mean, the background here is I was at a forum not too different to this online in 2020, and an investment briefing type forum, given other things I'm involved in. And almost an off-the-cuff comment was made, similar to some of the conversations. I think I owe Maurizio some money for the introductions. About we saw once again the same bad behaviour from investors during the crisis, with a particular reference to the first half of 2020. So we just thought, well, what does that mean? What does it look like as researchers and people who, particularly given our broader program of work and value advice? So I thought no harm in asking the question, asked the question, got the data, which we'll talk about in a minute. And the easiest way for us to look at that, first of all, was single switches. So people who made one switch over the period beginning of 2019 through to early 2021, and basically did a pretty simple financial analysis, I would argue. And it showed that, one, there was a lot of switches happening around that peak period of market disruption. If you visualise, and you'll see it in a minute, a map of the ASX 200 over that time period. The towers speak for themselves, as we'll see. Lots of people reacting during that peak period of market disruption. So we thought, well, is that good, bad or indifferent? And ultimately, as Mark has said, and as you can read behind me, for that peak period of time of switch activity and market disruption, at least in terms of the ASX 200, the vast majority of members who made those switches came off on the wrong side of the switch. You can use the other phrase, and so forth. So that was what we spoke about last year at this forum, online. Great to be here in person this time. And we thought, well, okay, what about the other third of the members that were in the data that we had who switched more than once? And particularly, as we'll see, can we infer anything about their behaviour and their attitudes to what they were doing? So that's what we're going to talk about today.
Perfect. Thank you. And I promise the title of this presentation is When to Hold 'em, and I'll keep the Kenny Rogers references to a minimum. But the first observation, as Mark said, is as the market bottoms here in March of 2020, two things happened. Members' switches to cash from growth options went through the roof, and Kenny Rogers checked out. So just when people were not knowing when to hold them.
You were told not to say that.
I was told. You're right. I couldn't help myself. But Mark, beyond the obvious here of history repeating itself, what were the observations in looking at this when we came to multiple switches?
So first of all, I love charts, as you know, and this is the only one in here, I promise, but let me quickly explain this. So this is a chart, obviously the yellow line is the ASX 200 over that time period I mentioned, probably see it into many people's brains. The bars represent net switches in and out of the cash option in the data that we had, so net. Not total counts, but net. So clearly there's switches going in all directions at all times. So the net gives you a sharper view of what was going on with the majority of, in this case, switch activity. We'll get to what the difference between the red and the blue bars are. That's just simply the very voluminous frequent switches versus the less frequent switches. We'll get to that later. But clearly, as you can see, the ride down, the whole investment adage of trying to catch the falling knife has gone in the wrong direction here. If you just sort of squint and look at it purely through investment principles alone. So lots of switches going on, first of all. So I'm not sure about you, but all of my training in investments over 30 years has told me be really careful when markets go into periods like this. And certainly if you sort of squint and align the almost vertical yellow line with the bars, you see the majority of the volume of those net switches into the cash option, given it's above the line, pointing in the upward direction, occur late in that downward cycle. So as someone mentioned in the previous panel, locking in that capital loss. We won't talk about it today. There's another paper we published earlier this year in Journal of Financial Planning, which is about crisis theory, and that talks about what was going on behaviourally in this particular crisis and looks at crises more generally and how that impacts on consumer psychology in terms of their effective ability to make good decisions. And with that in mind, I think there's probably three things I'd point out, again, mirroring some of the conversations I've heard today about this particular broad period of time, which, again, we all look back with not terribly fondly, obviously, given everything that happened. First of all, the psychologists and sociologists are starting to talk about this as the first crisis driven by social media, or heavily impacted by social media. So again, think of your member sitting on the couch in the evening, whether they're listening to my good old friend Tom Petrosky on the late night news giving the market update, or whether they're looking at all the commentators on Facebook, on Instagram and so forth about what's going on in the markets. This did impact people's behaviour and decision making. Secondly, accessibility to switches, we would argue, has increased dramatically. All the technology we've heard about. I don't know about you, I've switched my super a couple of times in recent years, and if you know which button to push and you know the language, in other words, you've got enough financial literacy, one might say, you can do it in a few minutes, or at least request the switch on your phone if you know how to get in, if you can remember your password and which button to push. That's a really interesting dynamic here. Access and choice is great when used well. And the third thing, of course, which I just mentioned, is also, and we've heard it a lot today, financial literacy has been a really important issue in the last few decades in the literature and borne out in the industry. Not trying to sound too academic, but at the end of the day, I'm an academic. Obviously, the literature has switched to a view now that we really need to be aiming for financial capability. And I accept that people often use those things interchangeably, but strictly literacy is knowledge and understanding. Capability is the ability to deploy it effectively in making financial decisions. I wonder how far along that spectrum we've got and whether that played a part in this as well.
And before we move on to the next slide, just let everyone know, at its extreme, there was a couple of switchers during this period who we dubbed the serial switchers. Give us a snapshot of those people. They're the extreme of behaviour, but they exist, right?
Yeah, so I think so when we look at the data in aggregate, and as we'll see in a minute, we had quite a few thousand switches, more than quite a few thousand, to play around with. And there were people in there that were switching weekly, if not even more frequently. Small number, and I generally, in my line of work, don't like to talk about outliers as the absolute truth for obvious reasons, but there's a lot going on in this period of time. And if you marry that up with the things I just mentioned, the crisis mindset, the ability, and what that does to people's, accentuates their biases basically in terms of decision making, coupled with accessibility, coupled with a little bit of knowledge, which might be power or it might be dangerous, suddenly we start to see some really interesting things going on in line with the comments, particularly Maurizio made earlier about how investors, or members in this case, in a really short period of time can make a decision that has a terrible impact. Could go the other way as well, and we'll talk about that when we get to the data. But of course, upside is great, and everyone's happy about that. But I think the suggestion that then turns into a complaint down the track is generally not that they made a switch and they had a great return and a great ride out of it. And there is that in this data as well, to be clear, a little bit of it. But the downside risk here in terms of members burning capital that is then very difficult to come back from is real, is what the data's telling us. Okay, so before we get into the findings, just give us a bit of a snapshot of and it's up here if you haven't got stuff there. Oh, you've moved on.
I have, yep. Move on to the next slide.
Sorry.
Of the data itself, so number of switches, just to frame it for people before we go into the actual findings.
It's a big data set. So if you imagine a spreadsheet with 125,000 lines in it, that's the size of the data we're dealing with. So it's a big fund, for lack of a better term, who gave us access to this information, line by line, switch by switch, including basic member demographics, age, gender, location, et cetera, and also what they moved into and out of at the individual fund or option level, which, as we'll talk about later, we've turned into a bit of a risk classification. So when you see risk here, it's not risk in the sense you might have spoken about it today, risk in terms of where they're moving up and down the investment risk from an asset allocation perspective. So we've tried to map all of that. 63 or so thousand members conducted these switches, so it's only switched members' data, not the people who made no switches over this period of time. And then when we first started in the single switch study, in the spirit of an event study, if you're familiar with that methodology, we broke the data into 3 categories, basically aligned with the different parts of, or 2 things really. One, that chart of the ASX 200 we saw before, but more importantly, if you've looked into the detail, or dare we forget, how COVID actually materialised at the very end of 2019 into 2020, and then we copped it here a few months later. So big data set along the way.
So, keeping with the gambling theme, this was a lot more complicated than the first round of switching research. So take us through how you approached it and what your initial findings were.
Yeah, no, as I said earlier on, the single switch data, it's a single point in time along that spectrum. You can see when they switched, what they moved into, what they moved out of, who they are. We just had a bit of a timing issue to aggregate, which we used with those 3 different timeframes. And along the way, we started to look at, as you do when you're what I call eyeballing the data, you look for really interesting cases and you thought, wow, there's a person that looks like a guru, right out at the top of that curve, right back in at the bottom. There's a panicker, and you start to sort of create these labels. And we thought there's something in this in terms of behaviour. That's what we believed, and so we set off in the second stage to try and work out how we're going to model that. And that's really complex with this data in particular. One, we didn't have all the variables we wanted. 2, if you imagine trying to sort of map out over timeframes, members that may have switched twice before COVID in 2019, may have switched through each time frame, might have switched up to 100 times throughout that whole cycle, trying to aggregate that and distinguish statistically who did what, and most importantly why, and what the outcome was, is a really troubling econometric problem. So what we basically did, and in order not to go into the detail of this, because I could talk about this for some time, and I've got a little bit 3 minutes per question to answer, wasn't it? We use a technique that's called latent cluster analysis, which is basically an iterative econometric technique where the data engine rolls through different combinations of the data sets by the data observations and looks for groupings, therefore the name cluster, within the data that are statistically different from each other. So it's not one person or one member versus the rest. Is there a grouping in this data? I like to use my hands when I talk. It's my safety net. That we can say with a degree of statistical validity that there's a group that look like this, behave like this, and there's another group that looks like that. And then we'd be able to go down this pathway of saying people who switch a lot with less positive outcomes look more like this on average. So it becomes a probability conversation rather than an absolute conversation. And that's what we've done so far with the data that we've got.
So your initial observation was almost the Pareto principle. A quarter of members were doing most of the switches. That was the first start point, yeah?
Yeah, so absolutely, in terms of the data as behind me, a third of the members did 2/3 of the switches. So straight away when we're looking at the single switch data, we're looking at the majority of the individual members, but the minority of the actual switches. And that's obviously given multiple versus single, right? So we really wanted to find out, well, what's peculiar about these multiple switches, if anything, that we could infer from, which would then infer something about their behaviour or something that audiences like yourselves might go, okay, so they're the sorts of profiles of people that we might want to keep an eye on in the future when the next crisis/incident comes along.
So that led to some pretty concerning findings. Take us through the high level of this. So
members of my team, and I should have said this at the start, there's a team of us, this is not my work alone, who've been working on this. We're having a lot of fun with the data. They sort of, as Em was saying, the propeller heads are going to a deep dark room somewhere and come out a month later with, we've got it. But ultimately they came out and said, this is all over the place. this behaviour, by any economic definition, is sort of irrational. The primary, there's more than one, but the primary set of clusters that came up as statistically distinguishable, as you can read behind me, are two groupings. The 97%ers, as we call them, which is the majority of the sample, who are predominantly members who switched less from 1, 2 or up to 3. There's a bit of an overlap between 3 and 4 between the two samples. And they are significantly, the odds of them having a good outcome come from a switch are significantly lower than the smaller group. What does that mean? That means the vast majority, as we said earlier on, of switches, even the multi-switches, are not faring very well when they switch during this period of time. We'll go into the detail a bit more, but so there is a significant difference between those two groups, both in probability and absolute outcomes from switching. And obviously the concerning point that Marcus refers to is that you probably want this to be the other way around, all things being equal, right? You'd want more members to be having better odds of getting a good outcome when they make these huge decisions, sitting there on their phone, switching under whatever premise. But unfortunately, and maybe that's sort of obvious based on that first chart that we put up, it's the other way around, at least in this period of time.
So let's talk about the first group, the 3%ers. Even these guys didn't necessarily come out of it unscathed. Take us through what you observed of this group. So
the 3%ers, likely to get it right 56% of the time. So just in terms of this is in terms of the switch return in a perfect hindsight, if they held rather than conducting the switch that we know they switched and then holding that up to the end of the period of time. Obviously, if they're a multi-switcher, it's a progressive switch, evaluate, switch, calculate, rather than the original hold position. So hence the tagline, which my team actually came up with, not you this time. You got to know when to hold them. I think that was a joke because I was singing a Kenny Rogers song, not that one, but another one at the time. So while they're more likely to get it right, they're not getting it right all the time. Okay, important distinction. This is the high switching group, as I said before, so a small group of the sample that are switching more regularly than the others, with a statistically significant difference. They're twice as likely, and this is the important part, to make what we've referred to as a high return. So we basically split the return profile, the switch return profile, into quintiles, so 5 buckets, high to high on either end of the spectrum. So this group is more than twice, 36% I think it was, more likely to make a high return than the 97%ers. Equally likely to be on the very low end of the spectrum as well. So no slight difference, 1 or 2% I think if I remember correctly, but therefore across the return profile and in absolute returns, more likely to get a good outcome and a very good outcome from engaging in switches during this period of time. The other important thing about this group is when we did that risk analysis, so the risk in terms of the types of investments they were switching into, this group was far more likely to be what in the investment world we might call making a tilt. So switching from high growth to growth. The 97%ers are more likely to be going balance to cash, growth to cash, those big leaps which sort of give you that mindset of bit of a panic, bit of a jump, bit of a, oh my gosh, what's going on, I'm out. While this group seemed to be a bit more astute in terms of the risk-on sort of model, taking a tilt out, moving a part of their investments to take a little bit of risk off the table, given uncertainty is how you'd like to frame it if you actually knew what they were thinking, and that's what the data tells us in that regard. That's also really important because across the whole sample, the odds of a good switch outcome grow up to a factor of 16 if the member is entirely or almost entirely making positive risk switches. So throughout that spectrum going up the risk curve rather than going down. In other words, if you hold them and or stay invested, you're substantially more likely on an odds perspective of getting a better outcome from the switches. Investment basics, right? But again, crisis, investor behaviour, panic, access, a little bit of information starts to paint an interesting picture.
Sure does. So what about the rest, the 97% who were even more challenged?
I'm not sure how I can politely put this other than to say they struggle. And this, in the previous session, we might have the reference to switches, if I heard it correctly, was if they get it wrong, this has big complications for those involved. Sometimes if you can execute and re-execute, those in the investment world know there's transaction costs and timing differences, but this is not what they do. The vast majority of this group, be they the single, the one or the two or three switches, in terms of the volume of switches they had, are likely to get out later. So after what we've seen happen in that curve, they're more likely to hold their position. They're more likely, as I said before, to be doing the big jumps, so from growth, balance, whatever they're in, to cash, and vice versa as well. And while they don't get the odds of that high upside of a very high return, they get equal odds of the very low, very bad returns. And clearly the numbers in terms of 97% versus 3% of the member group suggest that effectively that the end, if you like, is that the worst of investor behaviour hitting a crisis period like this is a volatile mix in terms of the members in our data switching the way they have.
So, are we screwed? What can we do? Let's go to the first one.
You go into that one. Look, I think one, obviously given my career, I'm a great believer in advice, I'm a great believer in data and analytics and information. The first thing I'd say is, and it's come up today multiple times already, there's a temptation here to sort of get sucked into the sort of the excitement, almost like trading. Oh, look, they're moving money around. Oh, look, the returns, it's great, big percentages. Ultimately, the conversations I have with my team about this are, why are people doing this with superannuation? In other words, the purpose of superannuation, as we've heard a few times today already. Okay, and the odd switch, if it's a reset because of some of the things we heard in the previous conversation about changes in people's circumstances over time, fine. Absolutely appropriate. But when we see this volume of switching of super at the system level around a crisis period, sort of makes you wonder what's going on and what we're trying to achieve collectively with super. And we mentioned before financial literacy. So from my point of view, and we're guessing here, we have done a little bit of work to try and draw back the characteristics of members in the various categories that I've referred to the financial literacy data. That data has been growing for 25 years now, and it's pretty much unanimous. You may have read a fair bit of it yourself, right the way back from Atkinson in the UK in the 90s, about the typical characteristics of an individual or a consumer who's more likely to be more financially literate and less financially literate, and there's a high relationship between our data. Now, we haven't measured the financial literacy of the members in our data quite clearly because we don't have that information and we don't know who they are, but there are parallels there. Concerning for me, and this, as I mentioned earlier on, is there's been not a lot, but a little bit of literature out of the US in particular that's shown, not surprisingly perhaps, a little bit of financial literacy can be really dangerous. So I wonder whether the absolute excellent work that's been done to engage members and raise the level of financial literacy is absolutely well done, well regarded, and needs to be continued, as we heard in the previous session. But I wonder whether that pushing that further to that financial capability level will help us manage some of these things and some of the other things we heard in the previous session even more as well. In other words, doubling down on financial literacy and moving towards a paradigm of financial capability, coupled with advice, I think, which is number 3 on the list, is really important.
Well, but help us draw the distinction. If we're thinking about financial literacy today, most funds are offering some form of education. What's the distinction we're drawing here for what needs to be done for financial capability? How do you differentiate that?
Really crudely, not as crudely as your analogy earlier on. And with, I'm an educator, so I take this with the best of intentions. Financial literacy is cracking someone's head open, dropping a finance textbook or a behaviour or a markets or a superannuation textbook, and then they know some stuff, and that's really good, and that will hold them in good stead. Capability is a whole other level where it's one's ability to take that knowledge, apply it in diverse and complex circumstances, and make effective decisions. So it's the ability to apply that knowledge. And I don't say that just in a general sense, but equally to be aware of one's own biases, which is really challenging. So it's a far more sophisticated use of that information. And that's the part the literature I referred to in the US. You may have read the Jumpstart Coalition stuff in the US about financial literacies in schools, for example. And it goes back to some of the points in the previous session about just-in-time advice and single points of advice as well. That people, if you teach people stuff at one point, or you give them that knowledge, whether they remember it, whether it's at their fingertips, so to speak, to make a point-in-time decision when faced with certain circumstances, is the challenge. And that's where the financial literacy literature, the research globally, has really struggled to demonstrate that financial literacy, using that term deliberately, transfers into more effective financial decision-making. So in other words, more to go, but I think that's really actually a huge opportunity and should be seen as an opportunity and quite exciting.
Definitely. Okay, in keeping with the crisis theme, item number 2 was one that you coined, the tsunami warning. Talk us through what this might look like.
And this is why I shouldn't play around with catchphrases and so forth. But so, as we do, we sit down and we look at our results and we talk about them. And one of the great things Marcus and I have been done over the years is we throw him our research and he tries to interpret and turn it into language folks like you can understand.
I play a very good lowest common denominator.
Yeah, because I often write long formulas and he says, what the hell are you trying to say? And this is really interesting because the conundrum, of course, is on one hand, you don't want to take away members' choice, right? It's their money, it's their funds. What would they... It's really difficult politically, but also in terms of just the rights of the members. But where does that obligation begin and end, as we heard again in the last panel? And that's a challenge. So from our point of view, statistically, at least theoretically, and certainly with more data, you could get to a point where you have a fine-tuned understanding of when these risks, the risk of members engaging in heightened levels of switching or members being behaviourally biased, let's say, and that goes beyond just typical flags. You can, as we heard last time, there's companies out there, market research companies that are using all sorts of digital techniques and sentiment analysis to work out people's frame of minds and when they're more likely to make poor decisions. Whichever way you operationalise it, the idea of the tsunami buoy, if you think of the tsunami buoys out there, which we've sadly heard too much about with natural disasters in recent years, it's not there to stop something happening. It's an early warning signal. It sends a signal to the authorities, in this case perhaps the fund managers or the trustees, to say, hey, there's a heightened risk here, there's something coming, be on your guard, up the level of communications with members, deploy those different levels of advice that we heard in the previous session to try and get ahead of it. Not necessarily to shut down member choice in this regard. Not for me to suggest that, but I imagine others have suggested, why don't we just stop this altogether? But ultimately work out when these periods of heightened market disruption, and it's not just volatility to be clear, it's market disruption, and put some signals in place that can at least heighten the awareness of members about the risk of doing what they're doing when they're thinking about switching for what many people is often their second, sometimes their biggest asset that they've personally got.
Okay. And then the third, obviously access to advice at all is very important, but there's some thoughts on potentially the importance of the scalability of that advice in times like this, yeah?
Yeah, look, I can't sort of compete with what was said in the previous session really in terms of getting to that large untapped group of members that are either disengaged or perhaps know a little bit enough, but are rather independent. And I should say, this piece of work and another piece of work actually started with me having conversations with advisors in March 2020, with some saying, man, we're getting phone calls like you wouldn't believe, people panicking, others saying, none of our clients are panicking, they all know what's going on. So I think in this space, anything that can be done, as we heard previously, to get access to more of those members in a timely way, either through an ongoing trusted comprehensive advice relationship or through other forms or levels of advice such as what we heard in the previous session, or even, as I said before, and I won't venture into the general versus personal debate, but even just communications to members just to say, hey, there's some really weird stuff going on out there in the markets. Don't listen to the late night news. Don't listen to my mate Tom. Don't listen to the superlatives on social media because it will make you panic. And if you are worried, go and talk to your trusted advisor or your trusted super fund or whichever mechanism it is. Because as I said earlier on, that impact of that information flow coupled with the notion of a crisis, as however you want to define it, the theory in many other applications tells us, as I said, even sophisticated individuals, and I don't mean sophisticated investors in that definition, sophisticated individuals in a general sense, their behavioural biases are accentuated during periods of crisis, and there's that sense of having to make a decision. I was saying to you before, Marcus, I was reading Howard Marks' latest update from Oaktree Capital, if you follow them, which came out on the weekend. And one of the lines he had in there, talking about these sorts of things, not switches particularly, but investor behaviour, was we've got to sort of stop members playing, or investors in that case, playing with their investments because they need to. So that whole sort of, I need to do something, don't just sit there, do something. Turn it the other way around. Actually, just sit there and don't do anything is often best. Investment history will tell us.
Absolutely, and certainly something that we've seen with the education content that we deliver into members. Josh, your insight on calling it help rather than education is a really pertinent one. We have to, I think, as an industry, broaden our conversation with the member and take what is referred to as super into the rest of life conversation of members to have that relevance, so that when we do get to times of crisis, not only have we built their financial literacy and capability, but we're the go-to from the beginning. It means a regularity of conversation and relationship that perhaps hasn't existed as much as it could in the past. So, thank you. There is copies of the full research paper, both the original one and this new one, available from the Griffith team. Almost available. Mark and the team at Griffith are really keen to do more of this work, so there will be people in the room who have the ability to and interest in providing data sets into the Griffith team to do this sort of work, be it public or private. It's a body of work that's being built, and it's certainly something the team at Iress are very keen to support. And then finally, if you are interested in understanding a little bit more about Iress's broader member education and digital advice offerings, then by all means, please speak to your Iress relationship manager.
The public policy cost of this runs to billions. I'm curious as to why you said it's your money, it's your choice. It wasn't. The 3-day rule and the 2-day rollover is an artificial creation of a system that's preserved. What's the public policy cost of this in total, do you think?
You're not going to push me into a number on this.
I am, because we're getting beaten up for basis points by the government. The cost of this public policy farce, where people are allowed to do this, runs into the billions.
Yeah, look, in fact, I had a conversation this morning with someone about, particularly in reference to what I heard when I came in, which I think is when you were talking, about, actually no, it was a wonderful policy update we had, well done, in terms of what the government may do around taxation and so forth around super. And that does raise the point of, well, if the potential here for capital to be destroyed in the blink of an eye for some members, sadly, what that would mean broadly, but also I would raise that out not just around the fiscal position, but also the whole notion, as I understand it, and stick to with super, about the ageing population and the need for resilience in the economy, so we don't have a 1950s style model, but where the demographics don't support it. We haven't, to be honest, we haven't done the calculations about what that would look if you factored it out across the whole super system. What I would say is, as Marcus said, is with a bigger data set. I'm personally really curious to see what happened in the last iterations with the Ukraine crisis, for example, and then there was another blip in the ASX 200 around some of the inflation concerns, to see how members have acted in that point. And with a broader data set, both horizontally and vertically, if that makes sense, I'd be in a position to be more confident to put a number there. But as you say, as someone who sits on some investment committees where if I heard you correctly, you get beaten up over basis points in terms of fees for a managed fund, for a managed account, or whatever it happens to be, it seems interesting that this, again, my hesitation is simply around member choice. That's the part that I struggle with. If the implications we've got here are cascaded out across the whole sector, that capital destruction around those peak periods of crisis and market disruption sort of makes those basis points pale into insignificance.
Yeah, Dr. Mark, I want to ask you a question. It's a medium difficulty question.
Thank God you're asking Mark then.
Mark or Marcus?
No, Dr. Mark. Dr. Mark, as you're now known. Forget Dr. Phil.
Sounds like my mother's husband.
And earlier on, we heard Dr. Mark say we're not in the happiness business. I agree. But we are in the business of being responsible. My question is, with the statistics that you've got on member behaviour, how many members give up? Because to me, that's pointed in the fact that most of our members are not financially literate or capable and do make emotional decisions. And I don't think that's a nut we can crack as a fund. We can't change that to the fuller extent required for smart decisions. So members are not making decisions. My question is, how many members did not make decisions to do anything? And what does that point to in terms of our responsibility as a fund to apply the right default?
Okay, that's a good question. Thank you. Well, as I said, first of all, so the data we've got is switch data, so it's members that did switch. So we can infer from that, knowing obviously where the data came from. And I think there was a slide up before that showed, and if you've read the full, particularly the first switch paper, or you're interested in reading it, you'll see that we refer a lot back to the literature. There was some switch literature done during the GFC. And ultimately that said, I think it was 3% of members during the GFC switched. We're talking more like 3 to 4 times that. So yeah, it's not everyone. There's a lot of members, as you say, that didn't switch. Our simple point is that those that did, particularly during that crisis period, again, visualise those high bars, it didn't go well. And to Martin's point, the ability for capital destruction in that period of time is huge, as I said. In terms of your broader point about all the other members that aren't switching, that's a complicated one, because I guess it depends on, at a point in time, how the members got to be with the asset allocation they've got. So was that they went in, they got a default, and there's a whole debate about the default versus other things, which I won't talk about while I've got a microphone in my hand. And then there's the whole position about, you know, what happens when people move funds, what happens when they get advice, and so forth. I would land on the side of an advice process that leads them to an appropriate asset allocation, whether it's time dependent, household dependent, or otherwise. And that's what a good advice process would lead to. And again, and by that I don't just mean comprehensive advice either, again, deferring to the previous session. But I think, well, a piece of work we did a number of years ago now, which was looking at intergenerational wealth transfer. There's if you've ever read that, there's about a 60-page report. At the very back of it, when it was just a curious thought that I had at the time, was about, well, what would it take to get to ASFA's comfortable retirement standard if you took the whole life cycle rather than the 45 years on or the 30 years on, or whenever a member, as we heard before, starts to take some interest in this. And the mathematics are actually pretty simple. And if you had a mechanism that expanded superannuation across the life cycle more so, you can solve some of those issues with pure financial mathematics and the basics of investment, compounding and quality assets over time. So that's my way of saying some of these fundamental principles about the purpose of advice, certainly the purpose of advice, the purpose of the superannuation system should be paid a lot of attention as that debate unfolds in the next little while. Otherwise, we might get dragged down in the corridors of quite a different debate and discussion, which I think is the heart of what you're asking me, if I've interpreted it correctly, about what really do members get out of this and what's the best way to shepherd them into that outcome as opposed to dictating to them. But again, that's where you land, depends where you land on the spectrum of choice versus fixed structures.
All right, I think that might be all we've got time for. Possibly more time than we were supposed to have. Thank you, Mark. Very much appreciate it.